I've never bought somewhere where I've been unable to add some value to it.
Starting small, but then building up to more complicated and sophisticated investments, what that journey looks like.
It doesn't matter where you are, if you get the right trajectory, ultimately you're going to win the game of money. If you focus too much on the big picture and not the next step you need to take, it could be a real pause button that's hit. This week we are looking at the investment ladder, where to start, which is rung one, and where to take that journey. Often this can seem daunting, don't be put off. It starts with simple baby steps right at the very beginning.
So we then climb up, baby. We've managed to budget and save, get our emergency fund in place. I would argue the next step probably in that ladder would be share market or ETF investing.
I think if you went down the logical best practice path, you say, oh, property should be your first goal as an investor, but it all starts with getting onto the ladder by saving in the first instance, budgeting and moving through, getting a deposit saved up to expand, to sell for a nice tax-free profit, to move into the next one and then the next one and then diversify from there. That's the game plan.
Next step is that bigger investment, I guess, for a deposit on a house.
It has to happen. A, we all need somewhere to live, and B, as the expression goes, rent money is dead money. Most of the challenge for people as they come into retirement is you can't really retire until you retire debt. Hey guys, welcome to this week's Money and Investing Show. This week we are looking at the investment ladder, where to start, which is rung one, and where to take that journey. Often this can seem daunting, don't be put off. It starts with simple baby steps right at the very beginning. As always, don't just take notes, make sure you take plenty of action. We'll see you in the show. Hey guys, welcome to this week's Money Investing Show with me, your host, Andrew Baxter, and as always, my offsider and co-host, Mitchell Olarenshaw.
Good to be here, Mr. B. Thank you very much for having me. Now, you and I both like climbing ladders in different senses, particularly in our corporate jobs throughout our time in history. Today, though, we're going to be schooling our listeners on the investing ladder. So starting small, but then building up to more complicated and sophisticated investments, what that journey looks like and what stage of life it should match.
Too right. Great trajectory, by the way. One of your better ones, I'd say.
Thank you.
I think the key thing is often we can be boxed in by where we are right now and actually neglect the trajectory that we can set ourselves up on. It doesn't matter where you are. If you get the right trajectory, ultimately you're going to win the game of money, which is what it's all about. So it is, I guess, systematic. There are a number of different pathways to the end goal. And of course, it starts by knowing what your end goal is. What do you want?
Yeah, I think begin with the end in mind, because, I mean, there's the basics of investing, which I think we all understand, property and shares being the most two common. When you, though, look down the line, as I'm sure you can attest to, developments, mezz finance, private equity, there's a whole different range of stuff out there for more sophisticated investors.
You're right. And you've got to grow into this stuff. And I think if you focus too much on the big picture and not the next step you need to take, it could be a real pause button that's hit. So focus on what is the next step for you in this journey, irrespective of where you are today. And I think that's going to start to give you the critical momentum that's needed to get there. So let's get into it.
All right. Well, look, I think rung number one on this ladder is building a safety net. I think that's the foundation of everything. So probably my first ladder would have to be saving and budgeting.
Yep. Look, I think saving is key because it's the foundation of any kind of investment behavior, and that is spending A, less than you earn, and B, then seeing that money growing for you. And I remember back in the day we had a passbook at the bank when you had savings. So for example, let's say you put £5 in there, it would all get written up that you've got another £5 deposited, and then they'd put on what interest you'd earned since last time, and you can start to sort of see your money grow, and it's that visualization of money growing. And I guess now we're in a much less a much more cashless society where a lot of things are on cards. So my kids just see us use cards all the time as opposed to cash. It's kind of hard because money's becoming this sort of, well, it's really a nothingness almost, whereas if you had
on a screen,
if you had your jar of savings physically, you can see something. And I think, to an extent, certainly when I grew up in the UK, and I know, Commonwealth Bank used to do the same thing here. They'd come around the school, give you a money box, and you can start to see great product placement, of course, but nonetheless, you could start to see that money sort of growing in size in the tin, and then you take it out of the tin, put it in the bank and keep going, and you start to see that physical process. And it is the most important thing to condition people on, is to learn how to save.
Yeah, it's funny. I remember being a kid, and my pop, he was quite savvy when it came to investment, stock market, property, and that kind of thing. And he told me that if I was to work a part-time job and save up money and give it to him, that he would then pay me interest on that money and give me the money back once I turned 16 or 15 or whatever it was. And I remember thinking, oh my God, this is just the most awesome thing. I can give him money, I get more back, and at the end, I get it all back. This is a great deal. Even still to this day, on the last day of the month, $30-40 of interest comes into my bank account, and I think, great, this is a free lunch and free couple of coffees. This is great.
It's such a crucially important thing. It's the one that people overlook. Oh, savings just like, what's the point? We just live hard, die young, whatever it might be. But it is the foundation of everything. Whether you want to then move into other assets later on, you need a deposit for a property, for example, or you need assets to buy shares. It starts with that saving, and you have to get it ingrained in kids pretty early. I think that's the crucial thing, and you've got to make it fun as well. And if it's fun and you can see growth and it's real, it might be slow, but you can see it. It's going to encourage you toward a lifetime of that. My dad's 83. I think he's still saving. Loves it.
100%, absolutely. And I think with all of this in mind too, out of that budgeting and saving area, the emergency fund is critical for me.
Absolutely.
I think none of us are impervious to life. Things happen. You get sick. You lose your job. You might have a child or whatever it might be. You need to have that cash set aside, I think, separate from your savings as that rainy day fund.
100%. We talk about this extensively, of course, in the Wealth Playbook. And, the initial goal is to have 1 month of expenses covered, whether that's your rent or mortgage, your utilities, all the essential things. And then we work towards then 3 months. And once you've got that sort of 3-month buffer in there, you can then start to say, well, okay, I've got that safety net in play if something happens. And with the rest of my cash, I can start to invest it. So you've got that cash put to the side. And there is a formula that we use in there. So as I say, it covers all the essentials. And then I think we work on about 0.6% of some of the other things that are less essential items, but you can have that in there as well. And once you've got that build up, then it brings a level of, I guess, peace of mind, which is extremely important in today's world.
Yeah, financial comfort versus financial freedom, which I think is where we're heading with this conversation. That's rung number one on this ladder. So we then climb up, AB. We've managed to budget and save, get our emergency fund in place. I would argue the next step probably in that ladder would be share market or ETF investing, purely on the basis it's low barrier to entry. So you could start with a small amount.
Yeah, I think if you went down the logical best practice path, you say, oh, property should be your first goal as an investor, but it's not a realistic one, because getting that deposit saved up, even with changes in legislation, is still a reasonable hurdle that you've got to hit. And of course, there's things like stamp duty and things like that to factor in there as well.
$1 million for a house median in Sydney, for example. Now I think even maybe more.
So, that is an enormous hurdle, and you can't save your way to wealth when you take into account interest at the bank, nice as a kid as it is to see your money grow. The reality with interest rates being cut, and even when interest rates are high, of course, they're only high because inflation is there, your real return is nothing. So you do have to take that approach where you've got to look to other ways of getting it growing. For me, my first investment was the stock market. That one at that lost all my dough with my first investment. Didn't deter me though. I've come back and sort of got that monkey off my back. But obviously, there's no barrier to entry when it comes to affordability. You can start with a very, very small amount, and I think in this day and age now, with things like ETFs, the ability to be able to diversify with one investment and to regularly add to it, I think is key. And I think that's a great rung after you've got your emergency fund set up and you've got some cash set aside, then start working on those stock market investments to grow your money to better get your deposit for the property market.
Definitely. I'm a big believer, particularly early on, if you are, let's say, for example, your goal is to get into property in the next 5 or 10 years, even just a broad index market tracking exchange traded fund. You've got no stock specific risk in there. It's fully diversified. You can let it sit there. You can add to it for the next 5 or 10 years.
Exactly right.
And then at that which point you could withdraw to then buy your house, for example.
I think exchange traded funds have been a game changer. They've made, a lot of people see them as being, it's a really basic tool, but they're actually a really powerful tool when you understand what they can do and the ability to bring different investment outcomes to you. I think that's a great pathway for people to take. And I guess, other people will have a different view of the world. And if your view is more slanted towards something like crypto, for example, look, I'll be straight off the bat, it's not my lane. I've dabbled in it, but it's not something that's my thing. But that's a pathway that many younger people are embracing. And I think the alignment of technology, particularly using crypto, makes it more engaging for younger people. I also believe that given the volatility in that market, there's the potential for an immediate gratification by instant gratification by sort of seeing your money growing. In theory,
up or down a lot day to day.
It gives you something that's engaging because it's always moving around. So that's an alternate to the stock market for those people that have that. As I say, not my lane. It's not a regulated market. I don't like it for that reason. But nonetheless, obviously, is massively popular.
Totally. And I think that the notion is you need to get money working above and beyond what you're getting at cash at the bank. As you mentioned, with the whole inflation concern, your real return is quite low on cash. Stock market, you're looking for that equity risk premium, I guess, if we use the fancy term, which is a greater rate of return.
Well, effectively, it's an outperformance. And, if you look at what markets have delivered, if you look at the sort of 10-year return on the NASDAQ is sort of in the high teens. You're not getting that on cash at the bank.
Definitely.
And if you bought an exchange-traded fund that just invested in the NASDAQ, you've had a significant return on your money over that period of time, which has hopefully helped grow you to that next rung on the ladder.
Well, let's get there now. So property, I'm guessing, would be our third rung here. You've saved up a good amount of money. You've invested in the stock market. Maybe you've got some cash there sitting as well. Next step is that sort of that bigger investment, I guess, for a deposit on a house.
I think it has to happen. A, we all need somewhere to live. And B, as the expression goes, rent money is dead money. You're effectively servicing your landlord's acquisition of an asset, which as landlords, I'm sure we both appreciate. It seems like a big step to take, and it is. It's for most people the largest financial commitment that they make during their lifetime. And I think as such, you can second guess the decision framework. But if you go back through history, and history can be a great teacher, you have to have exposure to real assets. And real assets are things like shares or property. You can't live in shares. So it can determine, I guess, two key things. Number one, it can give you somewhere to live. And if you're very shrewd in what you do, and look, I don't think, and this is something that's probably changed in more recent years, buying a house to make money probably shouldn't be the reason for buying the house. It's a side effect of buying a house if you do it well.
Yeah.
But it shouldn't be the overarching goal. Your goal is you can have somewhere to live, you got to have somewhere to base
lifestyle
yourself
decision, right? Yeah.
And if you happen to make some money out of that, well, that's a great thing too. So, get in there. It's going to save you on rent. You're building an asset base, which is going to let you propel yourself further forward. And, the view would be that I always have taken, whenever I've bought literally any property out of the multitude of transactions I've done in my lifetime, I've never bought somewhere where I've been unable to add some value to it.
Okay.
And
interesting.
And I think, if I look at my first purchase in London, which was a rundown Victorian pigsty when I bought it, and it was what I could afford, and I renovated it and turned it into something really quite special. And I made some great money from that, which parlayed me into my next one, into my next one, into my next one. But every one I did, whether it was a warehouse conversion or whether it was something else, was always with a view to, okay, I can live here. And there are things I can do to improve the value of that. Now, if you are not living somewhere where you can buy a Victorian warehouse and convert it, the ability to buy somewhere where you can extend it, for example, or you can add value to the landscaping, or you can put another bedroom on, or you can put off-road parking in there, or whatever it may be, are all ways of adding value to that thing that you've got, which A, you've got somewhere to live, B, you're not wasting money by paying rent, and C, you're building an asset which with some sweat equity and some effort on your part can turn into a bigger asset that parlays you into the next property or your first investment property for sure.
Yeah. And I think the goal for everyone in this space who's maybe listening to this is to have passive income over the course of your life. If you've got property that you live in, you've added value to, that's great. And then the next step, investment properties where you can generate an income, right?
Look, I think the big hurdle for so many people, particularly in Australia, is affordability, and it's a red light. It's a stop. You can't afford to do this. So people often either wait, give up, or take a different path with what they're doing, become maybe a global nomad and look overseas for somewhere, whatever it may be. The reality is there is never an easy and there's never a cheap time to buy property. It's just what it is in that moment, and the quicker. And that's true of any investment. Whether you try and time the market, is time in the market every day of the week. You say, you can time the market. If you bought your Netflix shares 5 years ago, you bought them for $160, they're $1,300 a share now, right? That's what happens when you get started versus trying to wait for the ideal time to get started. So, the big message in there is buy what you can afford. It almost certainly won't be where you want to live. And if I look at where my first property in London was, it's probably, I don't need to say probably, there's no way I'd live there now. But it's what I needed to do at the time to get my start. And I think you've got to sacrifice ego and arguably to an extent lifestyle as well, which is very, very hard to say I'm prepared to compromise. I can rent somewhere in a really nice area, or I can buy somewhere in a less nice area. When you're renting somewhere there, it's not yours. You're just renting the view for a period of time, and that will go at some point. Whereas if you own something, it's an asset that'll be there forever and a day. So, moving to an area that perhaps isn't ideal for you in terms of either ego or social standing, but may have great transport connections, or, my place in London, I moved from, one of the nicest areas in London when I was first renting to one of the rougher areas of London when I first bought. But it's also a 10-minute walk to the city for work. And so when there was the frequent tube strikes, which we see in the UK, I could walk to work with no inconvenience. It would take me an hour and a half to get there from the other side of town.
Yeah.
So the utility was kind of there in that respect. And that's a really important thing. You have to sacrifice your ego, and you just have to get off the blocks and start.
Gotcha. Couldn't agree more. Absolutely. Let's go up a rung now. Let's talk about maybe some more exotic type investments. And this is further down the line for those who are a little bit more advanced and probably older in age.
Yeah. Well, let's talk about diversification in your property portfolio in the first instance. So if you've got your first place you've bought, and, there'll come a time that you're probably going to upgrade that property for various reasons. If you've been able to add some value to it in some way, shape or form, perhaps you've got married and the sort of 1-bedroom pad or 2-bedroom pad, and now you've got kids. You don't want an apartment, you want a house and you want a yard and all that sort of. So it's the next thing on the journey, and that's that continual scale. The advantage in Australia of doing that is your primary place of residence is tax-free. There's no capital gains tax. I'm sure the Labor government will look at a way of slugging that in some way, shape or form.
It might not last.
But nonetheless, there's no capital gains tax. So it's one of the few ways tax-free you can significantly build your wealth. And that's something that, again, shouldn't be lost on investors. If you've the ability to grow an investment portfolio that gives you passive income, you might have a couple of rental properties, for example, where, yields maybe 3.5%. You think, well, that's kind of okay. But if you're timing the market really well from a CGT perspective, parlaying out of that 1-bedder into a 2, into a house, into a bigger house, can be a very, very powerful way of very, very quickly building your wealth. The challenge with that is you're usually selling and buying in the same market.
Yeah.
So, if prices have run up, what you're buying is probably going to be more expensive unless you buy something, again, that with some sweat equity, you can add some value to and build up. And I guess there's also a flexion point in there too, where you go, well, okay, I've got a house that does everything I need it to do. The next house, whether it's beachfront or waterfront or in a different, more ritzy suburb, for example, what's the motivation for that goal? Is it a financial motivation? Is it an ego motivation? Is it a utility motivation in terms of it's got the schools that my kids are at and the drop-off time is quicker and the connections for work are better, or whatever it may be. So there needs to be a matrix that sits around that. And at some point, you're almost better stopping playing that game and trading up and then diversifying. So you might have traded up a couple of times. You got a house that works for you and your family and your circumstance. Maybe you go for something that's a little bit nicer, but at some point you got to say, well, what's the reason for this? Is it pure ego, or is it time to now build other forms of diversified investment asset?
Yep. So investment properties, income generation type things. Income
generating properties, and or other assets such as the stock market, again, because you probably depleted your stock market account to get you started in property. Maybe it's time to diversify into that as well.
Interesting. Okay. Can we go up a rung now to our exotic investments?
Yep.
So this is probably more your lane than certainly mine. Development, mezz finance, private equity, all the complex stuff, more towards older age and sophisticated investors.
Yeah. Look, they're interesting, and they all have their merits and they all have their risks, I suppose. And as you move through the wealth chain, if you've done well, you can move into a category which is called a wholesaler or a sophisticated investor, where you've got over, I think, $2.5 million of investable assets to work with, or a net worth over a certain amount. The tax office will define that for you. And what that can open up are investment opportunities that aren't available for retail investors. And in the first instance, hearing that, it might sound like it's discrimination and it's not fair. The flip side of that is, as a wholesale investor, you're afforded much less security on those things, and assistance from the regulator and protection with consumer groups and so on and so forth. So, there's always a trade-off with that. So development is something I've done as an equity partner, where you've put up money to someone that's got the skill set in that space, and you do a share of proceeds, or you do a fixed percentage return on your money at the conclusion of the project. Look, and that's nice because, you're not keeping your cash at the bank and earning 3%. Developer finance, you're probably mid-teens. 15, 16% kind of return, higher if interest rates are higher. But there is, of course, a risk that goes alongside that. And I've seen the rainbow and the storm in that space. I've made some great money with it. I also had a situation where my builder and project manager both went bust on a project I was heavily involved with, and that wasn't so good. And there's quite a process of unpacking and fixing that when they've run for the hills and you're there going, well, I need to get my cash out of this. What have we got to do? And you've got to finish the job effectively, which is, and it was interstate just to compound it. So that's the sort of risk that sits alongside that. Mezz finance, second, third mortgage type finance, again, you're offering up money, but the security over that money is much lower. And I've got a buddy of mine who is extremely successful in that space. He's a former developer. He's sold out of his development business, and he was a pretty reasonable hitter, and has a lot of money that he puts out as mezz finance. And the rule that he has is really simple, and that's if something happened and it fell over, can I finish it?
Yeah.
And he has the cash backing and the skill set and context to be able to do that. Okay. So for him, he's buying something for cents in the dollar. It's almost the best outcome for him if you fall over, because he takes it on and makes a mozza out of it.
Okay.
But he's in a unique position, or a reasonably unique position, that he's got all of those three assets: the cash, the skills, and the context to be able to do it. So mezz is not an area I've particularly focused on, because I think there are other better ways with my skill set to get a better return on my money with significantly lower risk. And that, for me, as I've gotten older, is more important. And that's worth acknowledging too. As you move up that ladder, it's not just about return. It's not just about the next thing or spreading your wings. It's also about, I guess, shifting the risk-adjusted return on your portfolio of assets too.
Took the words right out of my mouth. And I think that's an interesting component to this conversation, is stage of life, because we're going to go through periods of time where you're at your peak, earning whatever is your peak is for your career. Then you're going to retire, where you're not going to have any income. Growth versus income. So how does that conversation intertwine with where you sit on this ladder?
Yeah, that's a good one, and I'm sort of looking at that real time now in terms of some of the property decisions that I'm making. In that, like, I've got a great stock market portfolio. I've got a wonderful primary place of residence. I've got international property. I've got domestic property, and now it's that phase where I don't have debt. I don't like debt, and that's a good thing, because most of the challenge for people as they come into retirement is that you can't really retire until you retire debt. So if you've got an investment portfolio of properties, let's say you've got half a dozen properties and they're all reasonably geared, the challenge that you've got is that the rent your property is receiving is going into servicing the debt. It's not going to you. As you get older, you need that money going to you because you need the cash flow. You're not working. And we've had clients that we've done, like Torp's a really good example of that, and others too, where, it's about retiring that debt down so that you can physically retire. So, I mean, like, my MO is unencumbered property, so that it's pure net cash flow as I move into that next chapter of my life. I'm not planning on retiring anytime soon. I own a great business and I love what I do, but nonetheless, it's got to be something that's also at the back of your mind, that where does that change in gear really happen? And so having an expansive investment property portfolio, for example, when you see people that pick up a lot of properties. I've got friends that have got a large number of properties, 50, 60 properties, or even if you're at a different end of that and you've got, say, 4 properties that are investment properties. The model for a lot of people it's been one that's worked very well, where you've had good capital gain. Buy a property, goes up in value, refinance it, take the equity out, buy another property, goes up in value, refinance it, take the equity out. Yeah. So all of a sudden you've got 4 or 5 properties, which is great from a diversification point of view. You go, look, I'm getting a rent check,
You don't really own many, more large portion of them, right?
The slab that you've got in there is pretty thin.
Yeah.
And so the view then needs to be, okay, well, you probably ought to go the opposite and actually start selling down maybe 1 or 2 of them and having the 3 that are unencumbered. And if you're renting out at $1,200 a week and they're unencumbered and you're shifting into retirement, $3,000 a week is a handy bit of income to pull you through in retirement.
They're also expensive to hold too.
Well, that's exactly right. I mean, I've just got one in New Farm at the moment, and so what do you got there? You've got Owners Corp rates, water,
insurance.
You're probably looking
property
at
manager.
Yeah, you'd be looking at probably 15, 18 grand a year, holding costs fixed.
I'm about the same on mine.
Yeah. So let's round it up to 20, just to say there's a special levy on it. So let's say there's 20 grand on an apartment. Now, let's say it's $1 million apartment for argument's sake, and that will be renting out. Let's say it's on a yield of about 3.8%. So what's that? That's what's that? it's about 50 grand a year. So it's $1,000 a week rent. Now you got to take out that 20 of costs, the fixed cost for holding it. So your actually net return out of it is 30. And if you geared up into that, and let's say you've got half the mortgage left to pay off. So you got $500,000 debt you got to pay off, but you're only pulling a net 30 a year. That's a blooming big mountain to climb.
You're going to be negatively geared in that instance. You're going to be dipping into your own pocket to support it.
Again, the transition in life is okay if you're working and you're offsetting it in some way against your tax, as you say, by being negatively geared. But if you're looking to transition into retirement, you can't be dipping into your pocket. It's got to flow the other way. So there's an expansion phase within your property portfolio. And then there's a contraction phase, and it's not sort of giving up or taking chips off the table. It's just restructuring that way so it does become significantly more cash flow generative to you. And again, you're talking about those sort of yields, 3.5 to about 4.2 roughly is, anything over 4 is pretty decent at the moment in residential property. When I compare that to what I can pull from the stock market, where, for example, if I'm using something like Hold the Strike, I mean, what are you pulling weekly in terms of the income on that?
0.5% to 1%.
Yeah, say
heavily leveraged though, high risk.
So 0.8% a week. Let's just say that.
I would say
as a number. That to me makes a little bit more sense. And again, if you say that's too racy, and instead you stick with something like cash flow on demand, where your goal is, let's just say it's 1% a month. Let's just say that's what your goal is from selling options over your stock, which is more than achievable.
Yep.
How does that compare then to a 3.8% return from property? Now, the big difference is, and I don't want this to sort of morph into a property versus shares conversation, which it seems to be doing, because they both have great value.
Yeah, they do.
One requires a little bit more hands-on, a little bit more work. One's quite passive, but one pays substantially more income than the other. And also, notwithstanding the fact that you can mitigate and manage all your downside risk on one of those, but not the property side. So
no holding costs either.
Yeah, holding costs and so on. So, it is horses for courses, but it all starts with getting onto the ladder by saving in the first instance, budgeting, and moving through, getting a deposit saved up, whether that's through investing in ETFs or crypto or whatever it might be that's in your lane, to get your deposit for your first property to get into as a house to live in, to add some value to expand, to sell for a nice tax-free profit, to move into the next one and then the next one, and then diversify from there. That's the game plan.
That's the game plan. And that is the plan. I think the most important thing out of all of this, you have to know what the plan is.
Well, people have got an idea of what that is from this conversation now. And if you look 30, 40 years down the line saying, I'd like to have, one of my mates in London, his goal was, I want to get a rent check every day of my life. So he ended up with 32 reinvestment properties, so that every single day of the month he got an investment check, he got a rental check for each one of those. And at the time he wasn't a hugely high income earner. He's done pretty well since, but he at the time he wasn't. But that was the pathway that he'd set himself on, and he's got property now. It's all unencumbered in central London, picking up a great rent check on the back of it. But it all started when he was on not a huge income, when he was in his early 20s, and he just made the decision that's a trajectory that he wanted to be on. And that's the thing more than anything, Mitch. It doesn't matter where you are today, whoever's listening to this, whether you're about to retire, whether you've just left school, or whether you're somewhere in between, which really bookends most of it. It's not about where you are or where you see yourself. It's the trajectory, that important word here, that you choose to go on. And it is your choice.
Well said. And I think we end it there. Thank you very much, AB.
Pleasure, anytime.
If there are words or phrases in this podcast that you don't fully understand, or perhaps you're someone that's looking to generate strategies to help build your wealth, make sure you visit wealthplaybook.com.au and grab your copy of our latest best-selling book, which is absolutely jam-packed with strategies, techniques, and most importantly, checklists that will practically give you a guide to create tomorrow's wealth today.